I serve as the lead portfolio manager for the Global Dynamic Change strategy. In addition, I manage several U.S. equity strategies, including small cap, mid cap, and mid cap growth portfolios. Earlier in my career as an analyst, I primarily covered the capital goods and services sectors.
I lead the specialist research team, which conducts in-depth, tailored research from perspectives that go beyond traditional company analysis. This includes industry analysis, thematic growth assessments, geopolitical analysis, private market research, and on-the-ground investigative work.
I am responsible for geopolitical and geoeconomic analysis. I develop Newton's proprietary insights into global geopolitical and geoeconomic trends, as well as their potential implications for equities, currencies, and fixed income markets.
Within this strategy, we actively incorporate Brendan's perspectives and outlook on geopolitics and geoeconomics into both the identification of investment sub-themes and our individual stock selection decisions. We also leverage the specialist research team's proprietary analysis, led by Raphael, primarily in our individual investment decisions. In situations where we see greater conviction or where additional clarity is needed, we request targeted, in-depth research on specific companies as appropriate. The inputs from both teams are deeply embedded in our investment process and serve as a key driver of our ability to generate excess returns.
While geopolitical risk was historically seen as more episodic and transitory, geopolitics is increasingly driving long-term structural trends that are impactful across asset classes and are important to position portfolios for. We are seeing an upending of the rules-based international order and shift to a more multipolar world with increased global security risks and competition. Security concerns are driving trade restrictions, industrial policies, technology controls and resource competition, impacting capital allocation decisions and market outcomes. Looking back over the past few years, we have seen a clear increase in global uncertainty. Developments such as the US presidential election in 2024 and Trump tariff shock in April 2025 have accelerated the rise of global protectionism and intensified US-China trade tensions. The Ukraine war and China's military expansion and assertiveness have driven increased defense spending in NATO and in Asia, with the Iran conflict reinforcing the global defense buildup. As a result, fragmentation and divisions across regions have become more pronounced and persistent. Against this backdrop of evolving global dynamics, our strategy seeks to identify and capture investment opportunities arising from these structural changes.
Within Strategic Resource, we focus on materials that are becoming increasingly critical in today's global environment. These include uranium, which is essential for nuclear power generation as its adoption expands globally, as well as rare earth elements that are indispensable for semiconductor manufacturing and defense equipment. In the near term, we are also paying close attention to key materials such as aluminum, copper, and gallium, many of which are designated as critical by the U.S. Department of Energy, as well as companies that contribute to securing stable supply chains for scarce resources, particularly those heavily dominated by China. By contrast, we take a more cautious long-term stance towards natural gas and crude oil. Advances in drilling technologies have accelerated commoditization and lowered barriers to entry, which in our view could lead to downward pressure on profitability. As a result, we believe investment opportunities in these areas are relatively limited. Within strategic technology and supply chain, we maintain a strong allocation to strategically important sectors such as artificial intelligence, semiconductors, power infrastructure, and quantum technologies. These areas are not only central to global technological competition, but are also critical for national resilience and long-term economic security. In the category of national security, we focus on next-generation defense technologies, including drones, unmanned aerial vehicles, and space-related capabilities such as rocket launches, satellite technologies, and missile defense systems. Looking ahead, we expect global defense spending, particularly among NATO members and their major economies, to accelerate further. In this environment, we favor US-based emerging companies and leading defense technology specialists, which are well positioned to capture increasing demand, especially from regions such as Europe, where technological innovation in this space has lagged. Within the strategy, we initiated an investment in GE Vernova in June of 2024. The company was spun off from the former General Electric and listed in April of 2024. It manufactures gas turbines for power generation and is also actively developing next-generation small modular reactors. In line with the second phase of Japanese government investment into the United States, agreed upon in March of 2026 between the US and Japan, GE Vernova, together with Hitachi, has secured major projects, including small modular reactor developments in Tennessee and Alabama, with a total potential value of up to $40 billion. Given its strategic importance at a national level, we continue to hold the position today. Our investment decision was supported by insights from the specialist research team, whose work deepened our understanding of the company and ultimately led to its inclusion in the portfolio.
Through this research, the specialist team conducted proprietary analysis on the rapid increase in electricity demand driven by the growth of AI, constraints in power transmission infrastructure, and the evolving dynamics of data center development. We identified that areas such as gas turbines, power transmission, and distribution equipment and related services are likely to benefit structurally over the medium to long term. More specifically, through detailed interactions with utilities, suppliers, and stakeholders across the hyperscaler ecosystem, we found that power infrastructure is increasingly becoming a bottleneck for the sustained expansion of AI and broader technology sectors. And while renewable energy capacity continues to grow, gas turbines and transmission-related services are expected to play an essential role in meeting baseload demand in the near to medium term, with demand likely to increase. This research helped us clearly differentiate between companies with structural advantages in the power sector and those whose performance is more dependent on cyclical economic conditions. As a result, it made a meaningful contribution to our decision to invest in the company within the strategy.
With respect to the Magnificent Seven, we previously held only NVIDIA. As a leading company in semiconductor design, an area of strategic importance to the United States, we invested based on its strong growth prospects. However, while we continue to devote substantial time to analyzing the trends and growth drivers of the Magnificent Seven, we do not currently hold positions in these companies. This is because we believe there are more attractive investment opportunities elsewhere. To elaborate on NVIDIA, while its share price remains largely flat from the summer of 2025 onward, many other semiconductor-related companies experienced strong stock price appreciation during the same period. In our view, NVIDIA remains a highly important player within the industry. That said, it is also very well understood by investors with extensive analyst coverage, and its valuation tends to remain at broadly fair levels. As a result, we believe it is relatively difficult to identify compelling entry points. Instead, our approach focuses on identifying companies where we can form differentiated views on future free cash flow growth. In many cases, such opportunities are more frequently found in small and mid-cap companies. We also pay close attention to the competitive landscape. While NVIDIA currently maintains a strong lead, companies such as Google and Amazon are developing high-performance semiconductor chips that can outperform in certain specific tasks. Intensifying competition could therefore pose potential downside risks to its share price. That said, we would consider investing again should we see a meaningful correction in the stock price. Within this strategy, we have held FANUC since inception. We view the company as a key beneficiary of the ongoing global shift towards protectionism and deglobalization, which is driving the reshoring of manufacturing by companies around the world. As a global leader in factory automation, FANUC is well positioned to benefit from these structural trends, which is why we continue to maintain exposure to the company. Looking ahead, we will remain focused on Japanese companies that possess strong technological capabilities and play a leading role in their respective industries, particularly those aligned with these broader global trends.